From New York City for our viewers worldwide, I'm Tom Keene in for John Farrell with 30 minutes dedicated to fixed income. This is Bloomberg Real Yield. Coming up, a busy show. Yields move higher after a mixed jobs report. The consensus, August will be revised to higher. We're forming jobs, but where is the wage growth? First, Carney, now President Draghi, the ECB, they struggle with disinflation. They may delay, balance sheet adjustment to December. Is it, real yields lower for longer? And it is September. The City and Wall Street, they consider how fixed income research will survive as we know it. And we start with the big issue today, without question, the U.S. jobs report.
1 month is noise, and I think the next few months will be noisy because of the disruptions associated with the hurricane. So I'm not sure investors should put too much stock in those numbers.
It is a little bit on the softer side. It benefits all of our positions in international markets where we think that returns will be higher, but we shouldn't forget that this number will be back on track before very long.
Claims are much more stable than payrolls, and they're not showing any problem. We've had a 36,000. We've had all sorts of numbers, but when it's not confirmed by other data, consumer confidence remains very strong. I think the market's going to blow this one off.
The first thing I looked at was the wage number, and it's been flat at 2.5 for a long period of time. We need to put more money back in U.S. consumers' pockets, and that's what we're trying to do, both by wage growth and by tax efficiency.
I think the Fed is focused on wages and certainly inflation to the extent that wages are reflective in that, and this is a weak report.
The best part about Bloomberg, the jobs report today, and those important voices. I talked to John Farrell and I said, 30 minutes? You got to be kidding me. We could do 3 hours today with our guests on the fixed income market and some of the changes to come for September. We've got a great lineup for you. Andrew Chorlton joins us. He's head of U.S. multi-sector fixed income at Schroders. Lisa Abramowicz from Bloomberg Gadfly, Bloomberg Markets AM on Bloomberg Radio, joining us as well. She really didn't want to join, but she said, okay, I'll join. David Riley with us in London, an important London here for fixed income and head of credit strategy at Bluebay Asset Management. So what we're going to do is dive into the news flow. But Lisa, I've got to go to you first on Harvey. It's been an emotional time, all the damage, the rescue, the too many deaths. As you go into September now, what does Harvey mean for the fixed income market?
Well, the question is, does it have a broader effect on the U.S. economy and how? And the irony is, when you talk to economists, they say it could have a depressing effect over the next few months as the U.S. spends more money. But in the longer term, it could actually lead to higher inflation and faster growth as people pump money into the infrastructure. The
distinction that I heard in numerous interviews is simply the scope and scale, the population of Houston. But the answer is the nation's fixed income market is so deep, it just, even the 4th biggest city doesn't move the needle.
That's right. That's right. I mean, people are not really counting it in their expectations.
Okay, so let's get started away from Harvey into where we are, and part of that is the jobs report. Before we go to London, let me turn to Andrew Chorlton here. How was August? I mean, did you survive in August? I mean, it's always a difficult month for fixed income. As you come into September, the look back to August, what was it like?
Yeah, I think August we saw a correction in most fixed income markets. We gave back a little bit of the strong returns we've had in investment grade and high yield, which is only appropriate. We hit pretty much the post-crisis lows in credit spreads in late July, so I think it's appropriate we gave a pause. But there was lots of issuance, and we expect that to continue next month. So we still would suggest remain cautious in your risk assets.
In our 3 sections today, we're going to look at the issuance in our final section with some of the minutiae in the middle. But David, let me go to you in London on the broader strategy here. There's any number of ways to go here, whether it's the jobs report and the like. Let us go to the ECB, the Bank of England, where you are, and of course the Fed. In September, what central bank action will matter for you in fixed income?
Well, I think the ECB and the Fed are going to matter a lot. I think in terms of the ECB, there's clearly more uncertainty around the ECB. People are expecting that they'll sort of prep for an October announcement around a taper, but your own reporters today have been suggesting that unnamed sources are going to be pushing that to December, which I think would be potentially a surprising and potentially even risky move to leave it so late. And then in terms of the Fed, despite the weak payrolls report, I think if you step back from that, I don't think there's anything in that report that stops the Fed from moving ahead with announcing that it's going to start shrinking its balance sheet starting in October. And I think if it didn't make that announcement, I think that'd be kind of bad for risk assets, actually. I think people would start thinking, what does the Fed know, or what is the Fed concerned about that we don't know about?
To me, that's price down, yield up. Is that one of the risks here, is with Fed delay, Andrew, that we begin to see finally yields higher and prices lower?
Yeah, I think we could see yields higher. I mean, the challenge with the US Treasury market specifically, it's the only safe haven really in the world with liquidity, so you're still going to get that bid in the event of geopolitical events. But certainly you've got the Fed taper, the ECB are going to delay, which is appropriate, because should they set 2018's QE before they know what they think 2018 is going to look like?
Okay, I want to show up this chart here, and I've shown this many times on other programs such as Bloomberg Surveillance. Let's go to the chart right now. This is 2-10 spread, and you know, we've been using this time after time after time. The blue circle in the middle is the Trump election. Up we go with hope, a steeper yield curve rather, and then we roll over. Lisa Abramowicz, we roll over, and you've done this brilliantly on Gadfly. The ramifications of the rollover in the clarion August moment is a retest of new curve flatness.
Yeah.
It's not a retest of recession discussion, is it?
No, it's not a recession discussion, but this flies in the face of a lot of the optimism that we hear from a lot of analysts saying the stock market still has more to go. We are accelerating. People dismissing the disappointing jobs report this morning, saying it's temporary. We're going to see better wage growth next year. This flies in the face of this. This contradicts that. This says you are wrong, and this creates a real tension in the market.
I love that. David, are you wrong? I mean, David Riley in London, the idea here of curve flattening, I mean, just away from the real yield, we had a dollar bull market. That worked out. We've had a dollar bear market. Have you been humbled in the summer as you go into September?
We haven't been humbled in the summer because we've been long in terms of emerging markets across a lot of our strategies, and you know, a lower Treasury yields combined with a weak dollar has been a very favourable backdrop for emerging market assets, emerging market currencies in particular. So no, we haven't been humbled, but it's interesting, as you say, in terms of, you know, you've had that flattening. I guess one question I'd raise is if you saw the 10-year, you know, move substantially below, meaningfully below 2%, you know, what's the tell in there? Because when we look at the data, and although you say the weak payrolls report, we've got a great ISM manufacturing print today. So all the data suggests that actually the global economy, the US economy is doing well. And actually we should really have somewhat higher yields as a result.
David, I want to go to you and then to Andrew. David, are we going to get to the point where the real yields are an issue? Are we going to see inflation rise against that nominal yield and give you a lower real yield?
Well, there's certainly, I think, a skew towards higher inflation given where fixed income and break-evens are currently priced. As I say, I think, you know, the global economy, the US economy, emerging markets, China, all support somewhat higher real yields than we have at this particular juncture. I think to some extent it's also, though, just reflecting both that sort of disappointment trade around sort of Trump reflation, and also some of the sort of geopolitical risk, Hurricane Harvey, some other sort of temporary factors as well.
It's a huge conundrum, Andrew, this idea of wither inflation, and it goes right back to real yields. I mean, you get a nominal, we talk all day nominal. Are we going to see diminished real yields as we saw diminished real wage growth in the United Kingdom over the summer?
I think, you know, the lack of inflationary pressure, particularly in wage growth, is something that is surprising people and continues to surprise them given how strong the jobs market is. I think the one sort of cohort that really wants inflation is ironically central banks, because the only way, or the easiest way for them to deflate some of these asset price bubbles that have been building is to be able to hike rates and use the excuse of inflationary pressure to do it.
Is inflation good for Schroders?
I think we can obviously manage assets in many market environments. We think inflation in terms of fixed income portfolios could be used as a hedge against the risk assets if we see any weakness there. But whether it's good for Schroders, I think most things are good for Schroders.
We're going to continue here. We're going to come back with Lisa Abramowicz and look at the minutia of the market, particularly issuance, as we go into the autumn months. We'll do that with Andrew Chorlton from Schroders, of course, Lisa with Bloomberg Gadfly and Bloomberg Radio, and David Riley in London with Bluebay Asset Management. Coming up, we'll look at the auction block as well. The U.S. Treasury issues, well, more than $200 billion in notes and bills this week. From our studios in New York and London, this is Bloomberg Real Yield. I'm Tom Keene from our studios in New York. This is Bloomberg Real Yield. Want to head to the auction block right now. This past Monday, the United States Treasury, they issued more than $130 billion in notes and bills. They did that in a 90-minute span. We focused in on the 5-year, the $34 billion debt sale. It drew a I got to go to 3 digits here, 1.742%, the lowest since October, with a bid to cover of 2.58. Primary dealers took just 17.5%, an all-time low. The next day, well, a 4-week, $25 billion Treasury bill auction, what made it be the final moment of a calm before short-end traders look at the politics of Washington when Congress returns to work next week. That debt matures September 28th, the day before the deadline that the Treasury Secretary, well, that he's laid out for lawmakers to raise the debt limit. And then looking to the north, thanks to recent Canadian dollar debt auction by Apple, corporate issuance is near a record level. That's an important item. Foreign companies issuing in loonies, the Canadian currency, have sold more than 15 billion Canadian dollars worth of debt this year, the busiest year for Maple bonds since 2007. Still with us, Andrew Chorlton, listening to me butcher a conversation on auctions. He's with Schroders. David Riley is in London. He thought I did a worse job than Andrew did, so we'll keep it going here. And Lisa Abramowicz from Bloomberg Gadfly and Bloomberg Radio, bond expert, is here to translate. There's 2 items there that I want to talk about in this section. I want to get to the Canadian and the Apple thing and the loonies in a minute. But that low ratio in auctions, that's Greek to a lot of our viewers. What does that low ratio mean? Well, nobody wanted the paper?
Yeah, well, there's a lot of question right now about what the real rate should be, just as we've been hearing from David and Andrew. Given the fact of what we're seeing from manufacturing right now, it seems like we should be getting more inflation. So people are getting a little bit jittery.
Andrew, you guys live and die this. I mean, David Riley's doing strategy and I'm doing the TV radio thing. Lisa's in the trenches of bond coverage, but you live auctions at Schroders. What is it like on the Schroders floor when you actually have a bigger and important September 28th auction?
I mean, we're trying to take a longer term perspective than just worrying about.
So you're on 3 days instead of the auction.
Each auction. No, I think you've got to take with a pinch of salt a lot of the data you get in August because so many people are away. So how many of the big Treasury traders at the banks are out of the office on their vacations in August? You know, even the payrolls data, people are saying, well, back to school kind of messes with payrolls in August. I think this certainly, as we get closer to the time limits of the debt ceiling, you're going to see a little bit more noise. But you know, there's some interesting comments on the Bloomberg TV earlier this morning. They're going to get it done. The US isn't going to default. We don't see that. We do see potentially volatility picking up, and maybe there'll be some opportunities as a result. But we don't see the sort of catastrophic.
No, you're trying to talk like me. Be careful with that. I'm done with you. David Riley, very important in London. One of the comments I always remembered from Sir John Templeton was the idea of a shortage of paper. That's a critical concept. Is there a shortage of paper in full faith and credit or in the corporate bond market right now?
Well, there's a shortage of safe assets within the Eurozone, and that's one of the dilemmas I think the ECB are having to struggle with in terms of its bond buying program. There's just, you know, the safe asset is the Bund, and the German government, unlike most governments, is actually running a balanced budget or even surplus, and so it's not really doing the issuance. In terms of on the corporate supply, though, I think one of the reasons, and you know, John alluded to this earlier. I mean, one of the reasons why we saw some backup in spreads in US investment grade over the summer months is because, for two reasons, because the supply has been so strong, and we're expecting another big print of supply coming into the market in September. So we've actually been lightening up in terms of US investment grade, actually moving more into Euro investment grade paper as a result.
Yeah, you want to mention something on that,
well,
Lisa?
One thing that I find really interesting is people talk about the glut of investment-grade bond issuance, and yet we have not seen the same kind of trend in high-yield issuance in the U.S. Yeah. Actually, total sales of U.S. junk bonds so far this year, $210 billion. That's below where we were in 2014, 2013. You can look at my terminal right now. The blue lines show the total volume of issuance. You can see it's up year over year from the same period last year, but it's down from 2015, 2014, and 2013. So we are not seeing record bond issuance. This is great. This is LEAG Go, and you can go to history and you can navigate with all of the custom dates that you want. You can see this is for the same year-over-year period. I find this fascinating. This highlights to me this sort of conundrum. People are, you know, frankly, this is why yields in the junk bond universe are going down, even as we're getting outflows. There isn't the supply.
Is Apple and other companies in the U.S., are they still going to go abroad to use other currencies to issue paper?
Well, they're diversifying their balance sheet and their financing. I mean, if they've got businesses in Canada, why not issue in loonies and then just have you know, no currency risk there?
Okay, we'll continue here. Andrew Chorlton with us, David Riley in London, and of course Lisa Abramowicz providing wisdom from Bloomberg Gadfly today. Let me look at the markets right now. The idea of a market check in bonds. We look at 2s, 10s, and 30s. We've got there the 1 week move and the yield 2.14% on the 10-year. That green number there, that's 3 basis points lower. That should be red. That's 3 basis points lower on the yield through the week. And it has been a tumultuous week, to say the least. So there we are with the 1 week yield. I'm Tom Keenan for John Farrell. This is Bloomberg Real Yield. It's time for our, well, the final spread. Coming up over the next week, a real interesting flow of news to get your September started. A German election debate, a BRICS summit in China, and of course the United States Congress returns from recess and rate decisions. We'll see that later from Canada, Brazil, and the ECB. Still with us, Andrew Chorlton, head of U.S. multi-sector fixed income at Schroders, Lisa Abramowicz from Bloomberg Gadfly and Bloomberg Radio, and of course, David Riley in a London that will be forever changed. He is with Bluebay Asset Management. David, I want to talk about how important fixed income research is. I've always learned that particularly in crisis, guys like you, guys like Andrew, always in every case, the fixed income people are out front of equities. How important is fixed income research in with the new lower pricing of the MiFID, help me Lisa, MiFID or
MiFID II.
I can't pronounce it. MiFID II. With MiFID II, what's going to happen with fixed income research?
Well, it's a good question, Tom, and we still don't really know the answer as to what is going to happen ultimately with research provided into fixed income from brokers as a result of MiFID II. Right now, we, I'm sure many others, are going through a process of, you know, assessing what's the value of the research that we're receiving, a price discovery process with the brokers, how we're going to absorb those costs, what it means in terms of of our clients. But fundamentally, what we've been doing and reflects, our basis as a house is, strengthening and building our in-house research capability.
Right.
And one thing about fixed income as well, when you're dealing with macro, is that macro is actually, a lot of that information is a public good. It's out there. So, and we have good access to policymakers as well. So I think we can, absorb the impact of MiFID II.
Andrew, you're in the trenches on this. I mean, I would think Schroders in London and frankly in New York is in the crosshairs of this. How are you speaking to the sell side? You're on the buy side managing money. They're on the sell side. What is that dialogue like? Take us into that dialogue a little bit without giving away the secrets of Schroders.
Yeah, I mean, well, similar to David, we put a premium on our internally produced research. We have a very research rate. We have a strong fixed income, equity, and data team. So that's getting the most of the investment. And as the negotiations with the banks around MiFID II continue, I think there'll be very much kind of a quality element to it, and there'll be some
fewer people.
Yeah, there'll be some people we're not willing to pay a penny for.
Well, I find it interesting.
She's brutal.
Well, but it's true. I mean, this is the reason why you're seeing banks lowering and then lowering and then lowering their expected prices. Credit Suisse today.
What do they do?
They lowered the price to a very competitive rate of 0 for fixed income research, and that was a story on the Bloomberg today.
Yeah, but I interviewed James Sweeney, their head of global economics, today on a jobs day. I believe Mr. Sweeney has children that need to be fed.
Right. Well, this is my question, because how does this also follow the MiFID guidelines, right? If banks have to strip out the function of providing research from trading profits, how do they provide it for free? I don't know how that works, but they're going to set an interesting model here.
Can we go longer? Andrew, I think this is absolutely critical. Do you end up only talking to 5 big firms, or is this good for the boutiques?
I think if you go back to why MiFID II is kind of happening, it's designed because there's a perception that research is an inducement to trade. I question whether the people who have that assumption have managed money before, because we don't trade unless we think we're going to make money for our clients, because the performance pressure is such. I think you'll just see a higher quality research produced both internally and externally, and the weak hands won't be with us.
Andrew, thank you so much. Andrew Chorlton with Schroders. David Riley, thank you so much for joining us from London. He's with Bluebay Asset Management. Much more to talk about, David, I know, in the coming months on MiFID II. Lisa, thank you so much for joining us.
Thank you so much for having me.
We never see each other. People think we do, but
we pass
really
in the wind.
We sort of like go down the hall. It's like...
It's just sad.
It's sad. From New York, that does it for us. We'll see you next Friday. John Farrow, Bloomberg Real Yield.